Welcome to the Hughes Optioneering Weekly Workshop, where we scientifically engineer trades for greater profit potential. This is the disclaimer slide. You can pause to read it. We're going to move on. Today we're going to look at MU, or Micron Technologies, Inc. MU is an American producer of computer memory and computer data storage, including dynamic random access memory, flash memory, and solid-state drives. Here's the barchart.com technical opinion rating for MU. The bar chart rating is a 100% sell with the strongest short-term outlook on maintaining the current direction. Long-term indicators fully support a continuation of the trend. According to Prime Trade Select rules, the stock is in a bear trend on a monthly basis if the stock price is below the 10-period or 10-month simple moving average. The monthly chart shows that MU has been below the monthly moving average line since last August, so the monthly trend in MU is down. Now we're going to look at the daily chart. The stock is in a bear trend on a daily basis if the 50-period or 50-day exponential moving average is below the 100-day exponential moving average. The blue line is the 50-day EMA line, and the green line is the 100-day EMA line. The blue line has been below the green line since the chart started, so the daily trend in MU is down. Next, we're going to look at a daily chart that displays the Keltner channel. As a rule, we don't want to buy puts if the stock price is below the lower Keltner channel line. Anywhere inside the Keltner channel or even above the Keltner channel is fine. MU is above the lower Keltner channel line, so MU is inside the sell zone. Since the trend is down, we want to buy a put. MU has plenty of option chains to choose from. We're going to use the June 20 chain. Right now, the June 20 options have 60 days to expiration. Here's part of the MU option chain for June 20. MU closed at 68.80 on Friday. That means any puts on the list from 90 to 70 are in the money. Let's take a look at the profit potential for buying the 70 strike put, which is the closest strike to the current price of the stock. The bid-ask spread for the 70 put is 690 to 705. We try to enter at the midpoint, so we'll use 7 even as the buy price. Our put option calculator shows the profit potential for this put based on MU price changes at option expiration from flat to a 12.5% decrease in price. We can see that if the MU stock price is flat at 68.80 at option expiration, the 70 put will lose 82.9% of its value. Ouch! This is an unacceptable risk. That kind of loss can wipe out a trading account in a hurry. We developed what we call the 1% rule to help us avoid this kind of risk. The 1% rule says to limit the time value portion of the option we buy to 1% of the stock price. That means the stock only has to move down 1% for the put option we purchase to break even and start profiting. Now let's take a look at buying the 80 strike put to see if it qualifies for the 1% rule. Here's the put option calculator picture for the 80 put. According to the 1% rule, we want the put to at least break even if the stock price is down 1%. The calculator picture shows that if the MU stock price is down 1%, the 80 put will lose 10.6% of its value. We want that to be break even or better, so the 80 put does not meet our requirements. Let's see if this is supposed to be the 70 put. Oh no, I'm sorry. Let's see if the 90 put will work. The bid-ask spread for the 90 put is 21.60 to 21.85. We try to enter at the midpoint, so we'll use 21.70 as the buy price. The 90 put works. If the MU stock price is down 1%, the 90 put will make a 0.9% or $19 profit. That's better than the break even, so the 90 put is the one we'll buy. The put option calculator picture also shows that if the MU stock price decreases by 2.5%, the 90 put will make a 5.6% or $122 profit. If the MU stock price decreases by 5%, the 90 put will make a 13.6% or $294 profit. If the MU stock price decreases by 7.5%, The 90 put will make a 21.5% or $466 profit. The 10% and 12.5% numbers are also displayed. You can see that the profits get better and better. And notice that if the MU stock price does not make the expected move down and remains flat at expiration, the 90 put would only lose minus 2.3% or minus $50 compared to the minus 82.9% or minus $580 loss for the 70 strike put that we looked at earlier. Now we want to review a put option debit spread, aka a vertical put spread. For this spread, we want to buy to open the June 20 85 strike put and sell to open the MU June 20 75 strike put. We're going to base our entry prices on the midpoint between the bid and ask prices. That means we'll buy the 85 put for $1,690 and sell the 75 put for $980. 1690 minus 980 equals 710. So the entry price or debit cost for the spread is $710. The put option spread analysis calculator picture shows that the spread will make a 40.8% or $290 profit if the MU stock price, it should say decreases by 7.5%. Increases by 7.5%, remains flat, or decreases in price when the options expire. Same profit with a 7.5% move in either direction. Creating the debit spread will allow us to collect a $980 cash credit to our brokerage account for the sale of the 75 put. As we said on the previous slide, this reduces the cost of entering the spread to $710. Here's a note regarding earnings reports. The next MU earnings report is scheduled for June 19, one day before expiration. Let's review the trades one more time. The first trade was a put purchase. It said to buy to open the MU June 20 90 strike put for 2170. We also reviewed a spread. Spread said to buy to open the MU June 20 85 strike put and sell to open the MU June 20 75 strike put on a spread at a debit of $710. That's it for this week's Optioneering Workshop. We look forward to seeing you again next week.